They're used to transfer money among. I'm Charles Tu, Daniel F. Mulvihill Professor of Commercial Real Estate at University of San Diego School of Business. I teach finance courses. The first question I usually ask students, what do you think finance is about? In a very simple way, finance is a subject about money, right? Everybody loves money. I think most people love money, but most people don't want to take finance classes because finance is much more than just making money, counting money. It's actually a study of the processes, institutions, markets, and instruments that are used to transfer money among individuals, businesses, and governments. A lot of people think finance is a study that is very intimidating, but people don't realize it's actually in our daily lives. This morning, I got a cup of coffee from Starbucks, $2.50. That is finance. That involves finance. A century ago, that is a simple cash transaction. You hand the cash to the shop owner, and then you get a cup of coffee. But today, Starbucks is a publicly traded company. That means to open the store around the world, Starbucks raised money through the stock market, the bond market. And to open the store in your neighborhood, Starbucks most likely doesn't own the space. Instead, Starbucks is leasing the space from the shopping center owner. The shopping center owner probably raised money to purchase the shopping center through the real estate market, equity market, debt market. And everybody these days use Starbucks apps. When you use the app, you have credit card, and the credit card the bank that issues the credit card, and Visa or MasterCard, the company that facilitate electronic transfer. All those entities, markets, instruments are involved in our daily lives. We just don't realize it. We take it for granted, but finance is so important. Real estate finance, you can say real estate finance is just the application of basic financial concepts and skills in real estate decision making. When you have a project, acquisition, or development, you need money. So you need to figure out how to raise money, what kind of institutions you can get the money from, what is the process, what are the instruments involved. That is real estate finance. People think finance is all about math because mathematics is so intimidating. People don't feel comfortable dealing with numbers. But finance is not just about math, and I think finance is somewhere between science and art, because financial decision making does involve some quantitative analysis. But true financial decision really depends on the individual's judgment, logic. So you can't rely on math, can't rely on equations to help you make decisions. You need to understand the mathematical side and understanding the qualitative side of the market, your personal preferences, so on and so forth, in order to make the right financial decision. A lot of time making a financial decision in real estate, you need to decide whether or not the project is profitable. That means you need to compare the revenues with the cost. You want to get more money in, then you have to pay money out. Or if you're buying something, you need to compare, okay, what is the price versus the value? When you go shopping, why do you buy something when it's on sale instead of at regular price? A lot of times it's because you think the product's worth this much, but the price right now is too high. But when it's on sale, it's marked down to this level, so the value now is higher than cost. So a lot of time we compare cash flows to decide whether or not it's profitable. When you're making money, when you get more than you pay, it's profitable. But even for nonprofit organizations or governments, you still need to understand the financial feasibility, because the objective may not be making profit, but you also still want to make sure it's financially sustainable. That means no one can afford to continue to lose money forever. So you need to at least be able to break even. That's when we say financial feasibility. To complete a project, you need to pay for a lot of things. Start with buying a piece of land, and then going through the entitlement process. You pay a lot of people, from attorneys to architects to engineers, and then finally, after you break ground, the construction, you have construction materials, labors. Once the structure is ready, you need to lease up the space. You have to pay brokers. You have to pay for marketing. So altogether, it costs you, the total budget could be millions of dollars. So when you look at that at the end, how much do you get out of that project? If you're going to sell it for a certain price, you want to make sure what you sell the project for is more than what you have paid for everything. In that process, that's when we're comparing the cost with value. That's how you measure profitability. If you're buying an existing building, then you have a different perspective, but you still need to think about, okay, I pay for this, and then there will be ongoing operating expenses. You have revenues coming from the investment, but you also have expenses. You want to make sure you make some profit. You have net positive cash flow. You have some money left over, and that is another way to look at profitability. So after you assess the profitability of a project, maybe the answer is yes, it will be profitable based on your estimation. You hope it will be profitable. Then the next step is, how are you going to pay for it? Because real estate is not cheap. Even your primary residence could cost you hundreds of thousands of dollars. When we talk about commercial real estate, it could be millions of dollars, even over $1 billion. How do you get the money to pay for it? That's the financing decision. Because in real estate, you can use your own money. But how many people can afford to use his or her own money to pay for a shopping center or an office tower? So you need to figure out what are the different ways you can raise all the money you need to pay for your project. That could be a partnership. You use your own money, invite partners to share financial resources with you, or you can go to a bank to borrow money. So basically, when we talk about financing, there are two primary sources. You have equity and debt, and those together will allow you to finance or pay for the project you are interested in carrying out. One thing I always at the beginning of my finance class, I will ask a question is, okay, $100 and $103, which one is better? So what is your answer? Think about that. I think the answer is, it must be a trick question. Cannot be that straightforward, right? Students always say, you must be tricking us. Yes, in a sense, because my answer is, it depends. And that answer can be applied, can be used to answer a lot of questions in my classes, but I always follow up with next question. Depends on what? Because you cannot just answer a question that says it depends and think I would let you go with that. So you need to understand, when you're comparing cash flows, $100 and $103, if I ask you which one is better, you need to understand what factors you need to take into account. First of all, the dollar amount, that's pretty straightforward, right? 103 is greater than 100. But you also need to think about, in today's global economy, are we talking about the same currency? If you're comparing 100 US dollars with 103 Canadian dollars, or Australian dollars, or euros, or Japanese yens, totally different value. So that is one thing, keep in mind, we need to be consistent. Secondly, let's say, to keep it simple, let's compare $103 with $100, both US dollars. Now that's pretty straightforward, right? $103 is better than $100. Not so fast, because I didn't tell you whether you're getting the money or paying the money. If you're getting the money, $103 is better than $100. But don't forget, a lot of time when you're making decisions, you're comparing how much you have the options of paying, the cost. This is something seems trivial, but very critical in financial decision making, understanding the difference between inflows and outflows. So $100, getting $100 is not as good as getting $103. But if you're paying, then you probably will choose to pay less than more. So those are the things you need to understand. Let's assume $100 versus $103, and you're getting the money. Which one is better? Now still, there are more factors you need to consider, because the next factor is timing. If the two options is $100 today or $103 2 years ago, now we have a tough decision, because if you get $100 today, you can do something about it right away. You can spend $100 right away, or you can save the money in the bank, or you can invest in different kinds of investment opportunities. So 2 years later, $100 may become a larger amount. So that is one of the important concepts in finance. We call it time value of money, because time value of money is a concept that can be described as $1 today is worth more than $1 in the future. So now, if you have $100 today and you can grow that into a larger number 2 years from now, you can compare that with $103. Then we don't know how much the difference, which one will be better. So now, okay, if we're considering those options, timing becomes important. Finally, another critical factor you need to consider is if you can get $100 today, that's much more certain compared to $103 2 years from now. Someone promises to pay you that money, but do you trust that person? Because you think you're going to get $103 2 years from now. If that promise is made by the US federal government, we assume that's very safe. We will get the money. But if it's someone you barely know, would you rather get the $100 now to be certain, or hoping to get $103 2 years from now? So now if you think about all those different factors in real estate financial decisions, a lot of time we need to compare cash flows. Similarly, pretty straightforward. When I first asked the question, $100 or $103 seems pretty straightforward. Everyone will pick $103. But you need to understand all the different factors you have to take into account to make the right decision. And that's the difference between finance, understanding the basic concepts versus a good decision maker. Because a good decision maker can take all those factors into account and figure out a way to make the right decision. So to finance your own real estate project, you can use equity or debt. So what does that mean? Let's consider buying your house. This is something people typically understand. If you want to buy the house, you need to have some down payment. What does that mean? Down payment is your own money. And with your own money, then you combine with money you borrow from the bank, then you come up with the total purchase price you need for the home purchase. And in this context, down payment or your own money, we call that equity. And the money you borrow from someone else, we call that debt. So debt and equity together represent the two primary capital sources. Equity is your own money, the property owner's own money, and that could be raised through a lot of different ways in the capital market. Time value of money can be described in one sentence, which is $1 today is worth more than $1 in the future. Because if you have the money, you can decide what to do with it now. You can spend it if you want, but if you want to grow your money, you can put it in the bank, earn interest. If you want to make more money, you can put it in real estate project, you can invest in stock markets, or you can bring the money to Vegas, put it on the roulette table, and hope for the best. So if you have the money today, you have that choice. and it allows you to grow the money to a higher level in the future. So $1 today will be worth more than $1 in the future. That is the concept of time value of money. If you don't invest your money or handle your money properly, then money could lose value, because there's a concept or a factor called inflation, which means the same product costs this price today could cost more next year, 2 years from now, 10 years from now. So if you put your money under your mattress, the amount will not grow. But the same product that costs you $100 today could cost you $102 a year from now. So the same amount of money you have will lose, we call that purchasing power. So the money, if it's not properly invested, will lose value. But if you properly invest it, whether it's put it in a bank, very safe, or if you're willing to take some risk, invest in different types of investments, it will grow. But that becomes an important factor to take into account when you're making decisions. So what is risk? Because in finance, one of the important concepts to understand is investments involve risk. In the US, if you put your money in a bank, there's a government insurance. So even if the bank fails, the government will cover your money, give your money back. So saving money with a bank is considered very, very safe. But if you want to make more money, you need to consider other alternatives, because the interest rate these days on your savings account or checking account is probably close to zero. So if you want to make a little bit more money, you need to consider other investment opportunities. Stock market, bond markets, real estate, there's so many investment opportunities, but there's no guarantee how much you can get back. And in some cases, you may not even get the money you invested back. So this is something you need to understand as, okay, the uncertainty, the potential outcome, the outcome you think is likely to happen or you hope will happen may turn out to be incorrect. The actual outcome of your investment decision could be quite different from what you expected. And that difference is called risk. So risk is uncertainty. Risk, potentially the loss of your investment, but even when you earn less than you expected, we consider that a type of risk. So when you compare how you use your money, going to Vegas, going to a casino, you're taking chances. Put your money in the stock market, you're taking chances. But the difference is the probability. Each game in Vegas has its own probability, whether you're playing blackjack or roulette or crap. So that is risk involved. You don't know what the actual outcome will be, but mathematically, some smart people figure out what is the probability of winning, what is the probability of losing. Similar situation in stock markets. As an example, you don't know, when you invest in a stock, you don't know exactly what the price will be a year from now, 2 years from now. Especially some startup companies now, very attractive stocks, WeWork, Uber, but they're not making money. How do you know 5 years from now, 10 years from now, the company will still be there and they will be profitable? So it's almost like going to a casino, betting, right? But the difference is, in a casino, mathematically we know the odds are in favor of the casino owner. In the stock market, because you're not betting against a casino owner, you're actually, in a sense, betting against other investors. So all those investors are rational, they're making financial decisions. So the market actually will determine what is the right price you should pay for that investment based on the expectations. So how much you can get, how much you have to pay for it is determined by the market demand and supply, and usually is much more fairly priced compared to casinos. Some students feel that finance is a very scientific subject. Among all the different business disciplines, this is hard science because everyone thinks, okay, finance is all about equations, theories. I think yes and no. We actually go through that process of evolution in the 1950s when some financial theories were first introduced. That changed the field. And over the next few decades, several financial economists, they received the Nobel Prize in economics. So finance becomes a very theoretical, scientific subject. But in the last 10, 15 years, this field continued to change. And these days, a lot of people talk about behavioral finance. That is taking human psychology into account instead of relying on those mathematical equations to explain how the market behaves. And Dr. Richard Thaler, a famous behavioral economist from University of Chicago, won the Nobel Prize a couple of years ago. And that shows that this field has changed. So this is not just pure science, because when you make decisions, you have to understand why, how people will behave and why. So it's not just about the bottom line, a number or an equation. It's how you take those factors into account so you have inputs into the equation. So again, finance is not just about numbers, because a lot of decision making involves equations, but it's not the calculation or solving an equation that is critical in that process. It's how you determine the inputs you can put into that spreadsheet or enter into the equation. That is the art portion of finance. Finance, this profession, needs people with different skill sets. Traditionally trained quantitative experts, they can play certain roles, but in this profession, we also need people who have certain soft skills. They have the different background, liberal art background, maybe psychology, maybe philosophy, because they bring in a different perspective. Decision making is not just about crunching numbers. A lot of time you need to understand the numbers, whether they can explain how people behave, or figuring out how people behave may affect the inputs into your mathematical models. So finance, there are a lot of different career opportunities in finance, in real estate. So definitely, if you're a traditionally trained finance major, you're a real estate major, great. You can find opportunities, career path in real estate. But if you're not a real estate major, if you're not a finance major, this field is very multidisciplinary, interdisciplinary. So there are a lot of opportunities. You can actually utilize your skill, utilize your strength in the field of real estate and finance. So a lot of students, when they take my class, they're so worried at the beginning. They say, oh, finance is hard. I heard from my friends, they suffer in finance classes. Is finance hard? Yes, it's not easy. But is that rocket science? No. I think sometimes people just feel intimidated at the beginning and then don't even want to learn or get to know finance, because it's like getting to know a person. Okay? The person may be very nice once you get to know him. So finance is more about logic. It's more about intuition. This is not science, it's not mathematics. You use mathematics as a tool to help you make decisions, but if you're logic, if you have logic, if you're logical, if you have intuition, you can understand it, finance would not be hard. Real estate finance, this is a wide open field. If you're good with math, you can find a path in real estate finance. If you're good with interpersonal communication, you're a good salesperson, you can find a career path. if you're good with organization, you're detail oriented, you can find a career opportunity. There's so many different things you can do because real estate finance is not just about finance, it's not just about real estate. It involves so many different things, from extremely right brain to extremely left brain. You can find a way. The important thing is that you understand what real estate opportunities are. Entering this study with an open mind and look at yourself, assess your strengths and weaknesses to figure out the right match, because it's all about finding that right pairing.